There's a massive edge embedded in option prices for those that are willing to capture it. It's called the variance risk premium, and it's the observed historical spread between implied and realized volatility. Or to put it in simpler terms, the premium options trade at above their fair value. In this video, we're going to walk you through 3 tips that you can use to make more money trading the variance risk premium, as well as showing you the exact process that we use to capture this edge, from coming up with ideas to execution of a real trade in our account. This video is going to go through some of the higher level volatility trading concepts, so if you're not familiar with the basics, check out the video that we made on it. And if you want an even more in-depth guide to trading these types of strategies, check out our free ebook linked in the description. To refresh your memory, selling options is a profitable strategy because options offer buyers unlimited convex profits and limited downside. This is an attractive return profile, and anyone taking the other side of the trade generally demands a risk premium for doing so. As volatility traders, instead of using options to trade directionally, we're betting that the market is implying a higher volatility than will be realized by the stock, or a lower volatility than will be realized by the stock. When we look at historical data, we can see the former has consistently been a good bet to make. That's one of the primary reasons we even bother messing with all of this complicated volatility stuff. There is a blatant and robust edge that's apparent here even from an eyeball glance. We'll talk more about this later. Being that the return of a direction neutral option structure is vega multiplied by the volatility implied minus volatility realized, assuming we're net selling options, this spread quite literally translates into dollars, and we can sell straddles, strangles, hedged puts or calls, or other direction neutral option structures to capture it. Let's get into tip number 1. The variance premium is a risk premium, so get ready to take on some risk. I'm sure at this point that you're absolutely overwhelmed by the insightfulness of these tips, but hear me out for a second. Let's think about the equity risk premium. Holding stocks is risky. Stocks tend to go up like an escalator and down like an elevator. The track record for being able to predict crashes is terrible, and conveniently, when stocks drop, this usually happens to be the exact time that you want your money most. However, while all this risk is unpleasant to say the least, we can't be too upset about it. The risk is the reason the premium exists. If holding stocks wasn't risky, there'd be no premium. Similarly, the variance premium is a risk premium.
I think the thing you have to realize with a risk premium is it's right there in the name, it's risk. So you have to look for situations where there are obvious sources of risk and then decide if they're fairly priced or not. In order to collect the risk premium, you have to take some damn risk.
From the quant perspective, risk usually means your return distribution is highly negatively skewed. Your largest returns are going to be negative ones. Small capped wins with occasional massive uncapped losses. Imagine it like being a stock market insurance company. You collect premiums day after day, but eventually that hurricane is going to happen. Unlike some kind of special, secretive, arbitrage alpha signal, importantly, the variance risk premium doesn't exist because nobody knows about it. It exists because getting it is risky and often unpleasant. While this could be seen as a negative by some, the fact that the edge is persistent despite being widely known can also be seen as a good thing. Unlike some kind of news-based alpha signal, the variance risk premium has multiple strong reasons for its existence, which means it's likely that we'll be able to continue making money from it for a long time. Because we now know the variance risk premium is a risk premium, we can actually reverse engineer the process of finding expensive options by finding places with risk. If we know option buyers are primarily looking to hedge stock portfolios or get leveraged exposure to the direction of the underlying, we can start to find situations where there is likely demand for one of these things. One example of this idea is meme stocks. Option buyers in these cases were volatility insensitive. They weren't concerned with whether a call was priced fairly. They just wanted that sweet leverage, that exposure to the upside of GameStop. As volatility traders, this was a situation where we could come in and sell an at the money straddle to capture the large spread between implied and realized volatility. Another well-known example of this is equity earnings reports. We know on average the option market implies the stock is going to move more than the average move that we actually see through the earnings announcement. And in both of these cases, we have to remember, the reason the premium exists is because there is a real risk that the meme stocks will jump another 300% in a matter of days. There's a real risk that Facebook will shed $232 billion in market cap over its earnings announcement. Knowing this, the game when trading the variance risk premium is not how can we make money, but instead, how can we keep the money that we make? What safeguards can we put in place to protect against the large negative skew that comes with these strategies? This leads us to tip number 2, size down. We're retail traders, not math experts, so we're not even going to try and explain optimal Kelly sizing for continuous outcomes. We'll link some papers in the description if you want to read about that. Instead, we see it's not too hard to intuitively understand how sizing too large destroys your trading profits. If you start trading with $10,000 and lose 30% of it, you now have to make over 40% just to get back where you started. When we plot compound growth rate as a function of volatility, we can see how volatility erodes expected returns. Knowing this, we found that a good way to size volatility trades is to stress them to a certain change in implied volatility, as well as a change in the underlying stock. This is where your own judgment comes into play. How realistic is it for the stock to jump 20% overnight? If you're trading a meme stock, it's fairly realistic, so size down accordingly. If you're selling SPY puts, that 20% jump is far less realistic, so size accordingly. You can use the price slices tool in Thinkorswim to stress positions based on changes in implied volatility and changes in the underlying stock. Tip 3. Scan for a spread between implied and realized volatility. Ironically, one of the simplest yet most effective forecasts of today's volatility is whatever volatility was yesterday. Volatility tends to cluster in the short term and mean revert in the long term. This is why, despite what Tasty Trade might think, randomly selling high IV rank with no other analysis, it's probably not a great idea. Instead, finding stocks with a large spread between implied and realized volatility is often a good way to find trades. This signal is not as strong as it used to be, but still tends to have some predictive ability. While we don't think blindly selling volatility on stocks with a high implied to realized spread is a good idea, it can be a good starting point for your analysis. We like to set up a scan where option volume is above 1 to 2,000, so it only shows us tickers with liquid options. We want no events in our 30-day implied volatility window. This filters out any earnings announcements or other known events that would push implied above realized volatility for a reason. And finally, an implied volatility to non-event realized volatility spread, anywhere from 1 to 1.3. Non-event realized volatility basically cuts out any of the earnings events that might be skewing our measure of realized volatility in the regular day-to-day movement of a stock. What we're left with is a selection of stocks whose options appear expensive relative to their fair value. If we assume historical realized volatility is a very good forecast of what volatility will be going forward, we can see how there is likely an edge here. Now let's walk through exactly how we place these kinds of trades using an example in our brokerage account. If you were using options to hedge sector or market risk, you'd most likely be a buyer in either an index or an ETF. And we see this consistently in the data. The variance risk premium is the strongest in the index. While we do see it in single stocks, finding stocks with a very large variance risk premium requires more work and knowledge. So for the purposes of simplicity, let's just look at some ETF volatility. USO is an oil ETF that invests primarily in crude oil futures. When we look in the historical data, we see a large premium of implied over realized volatility, with a mean of over 1.2. In fact, you really only need to eyeball the implied and realized chart here to say that selling options has been a huge winner. This is exactly what we're looking for. For retail traders with no access to complicated execution algorithms or cheap commission rates, who have jobs and can't be glued to a desk all day, we're not looking for some super small mispricing. We're looking for an overwhelmingly obvious edge that passes even an eyeball test. We can also see here that while realized volatility has been dropping over the past few weeks, implied has stayed more than elevated. This is the exact setup we like to see when making these trades. The next step is to create a forecast of volatility. You can use 20-day realized volatility as your forecast. However, the average of multiple models tends to be more predictive than just one, which is why in our terminal we use a blend of implied volatilities, realized volatility, as well as the S&P volatility and its relationship to our stock. We'll use that as our forecast for this trade. Let's move over to Interactive Brokers and look at market prices. If we look at the 32-day USO option expiration, we can see the 50 delta straddle is going for $4.69 at the mid price. Using an option calculator, as well as our forecast of volatility, let's calculate the fair value of that straddle. Inputting the stock price, strike price, days to expiration, and fair volatility, we can see that the straddle is worth $3.19. Being that this isn't some high-frequency arbitrage strategy, we can afford to be a little less aggressive on our execution. I'll start by putting an order at the ask price, then walking it down slowly. We might be able to uncover some hidden liquidity between the bid and ask spread. After slowly walking my order down, I was able to get a fill at $4.61. Looking at our fair straddle price, this gives us an edge of $1.42 per straddle, or $142 in our trade. This is the exact process that volatility traders use every day to trade the variance risk premium. They build a forecast and use it to see where can I find expensive volatility across the options market. And by doing this, they spread the risk across many trades. They're able to build out a very profitable book for themselves. Importantly, we understand that we have a good reason to make money in this trade. The variance premium, it's risky, and there will come a day when we have to pay out our insurance claims. but the premium exists because we're providing value to another market participant, offering them a way to hedge their portfolio or a way to speculate on the direction of a stock. By following these steps, we believe you can consistently profit trading the variance risk premium net of the occasional hurricane.